I get this question a lot, and lately Jonas, my partner in the business, also Joan Taruk, also gets this question a whole lot in our business. There's a lot of fear and trepidation around buying this time around, and the majority of the question that we get is, are we buying into a housing bubble? Good day, everyone. My name is Bobby Taruk with Keller Williams Premier Properties, and it seems like my video is lagging. And out of the Glen Ellen Market Center with us today is Eron McCormick, attorney with a law practice focused in real estate and estate planning in Wheaton. Eron?
Thanks for having me, Bobby.
Hey, Eron. Yeah, we'll go jump right in. This is part two of the topic that I've covered. Are you getting these feedback as well from either from realtor partners or also from just real estate clients, buyer clients? What are you hearing on your side as well?
So, what I'm hearing on my end, not necessarily from agents or lenders that I work with, I don't think it's going to be the '07, '08 bubble. I think more of the concern is what is the interest rate. And historically, when you look at the data, interest rates are still better than they were or have been historically. I think the issue that we're starting to see is people who held out thinking that interest rates may become lower are now having a rude awakening that interest rates have gone up because of what's going on with the market. And also, the housing supply is not there. Um, and so, buyers think with the housing rates going up, that sellers have to lower their price or be more willing to work with them. In some ways, the housing market may have softened slightly, but sellers are not giving in to buyers' demands, and there's still a competitiveness for housing. So buyers are still having to, waive their inspection if it's not an as is. We're not seeing as many as is homes, but if it's not as is, sellers are giving in slightly more, but not to what people think they're going to get. People putting in 100% on tax prorations, thinking they're going to get 105, 110, 115. They're going to be able to ask for a laundry list of items after they do their inspection on an as is and then get a bunch of credits to claw back whatever they believe the price is worth that they've overpaid on. That's still not working. So I think it's more of a supply and demand issue. What I've seen, some things from like CNBC, um, online blog stuff you read, economists who are smarter than I am, builders will eventually now start building homes. Let's see where the economy goes, and hopefully that will help the housing supply. But as of now, I hear more about the interest rate than the housing bubble. Those are my clients' concerns.
Okay, yeah, absolutely. And we'll go step through here. I'll go to a slide as we move along here. Just a slide in here that how the direction of the interest rates as inflation goes up and as the Fed fund rates go up, the mortgage rates go up. And then after some tightening of course, of through fiscal and monetary policies by the Feds, the interest rates actually go down as inflation goes down. So we'll skip around in here. Like I mentioned, some of these I covered in a previous YouTube video. Uh, uh, we'll cover the housing formation, and then we'll cover probably this is a little bit near and dear to your heart is around lending policies. And then we'll cover the last bullet in here, the home prices continue to gain amidst recessionary times. So I think one key part that is not really covered in conversations and even articles of so-called experts in CNBC, as an example, or even Fox Business. Actually, the only person I've heard talk about this regarding household formation is Barry Habib with MBS Highway. So this is a slide on household formation versus housing starts. Now, this is for single-family housing starts. So in essence, the family is occupying an owner-occupied home, and then as I mentioned in a previous YouTube video, Junior is aging out of the basement. He's done with his master's, or They're very highly educated, especially for I'm talking about the millennial generation who are aging out of mom and dad's basement. They've done their graduate program and they have a high paying job now. They're really ready to start a family, and they move out of mom and dad's house. And in essence, that particular scenario, they're forming a household. And you can see in here, if you can take a look at the graph, hopefully you can see this too well or very well, is that sometime around '05, the housing starts overtook household formation. And we know what happened in '08. So you'll see that downward trend of the histogram. But right around 2017 and onward, you'll see that housing starts has been lagging behind household formation. I'm not sure what was the big spike. I think this big spike was in COVID, where probably there were a lot of households formed is because of social distancing. And I think that was primarily because of COVID. But after right around 2021, there was a big dip. But you can see in here, ever since around 2021, housing starts has been lagging behind for single occupied uh, homeowners. But in the past, it's always housing starts has kind of kept up. But we know with supply chain issues and then the lockdown in Shanghai, I think this will continue to be the trend. And if we look at also for multifamily housing, right around 2021, there was a big dip, of course, with renters, probably with the lockdown again, and then the moratorium on eviction. There was a big dip, but you'll see right around 2021, housing starts has been lagging behind the household formation. You'll see that there's a big jump right around 2021 in terms of the number of renters, household formation that is for renters, but the housing starts, at least for multifamily, has been lagging behind. So this really explains a whole lot, Aaron, I think, in regards to why rent right now is so expensive. And the last time, I think it was something like 70, 79% increases in rent. And that's been a core factor of core inflation. And I think this explains a whole lot why rent is just so fast in terms of rent hikes, primarily because it's a function of supply and demand. Would you agree to that?
Yeah, and I would also add to that that I've had more than two handfuls of clients sell their home because they bought when interest rates were low or lower and made improvements. The value of the home significantly went up, and then they cash out, pay off their mortgage. Um, they're in their mid years, late 40s, early 50s. They're 10, 12 years out, and they're going to rent for a few years and see what happens and take their profit. But I still believe in the value of home ownership, not necessarily renting, having investment property. I like renting out rentals, but me personally, I don't know that I'd want to rent. There's always
Right.
a
Mhm,
place for each thing, renting versus owning, but
mhm.
hopefully that works for those clients. I don't know that I would do that in this market with rents going up the way they are.
Yeah, absolutely. And I think that, again, with the supply chain issues, it may be that chain issues will subside to some extent. Lumber prices, as an example, has gone back down. Gasoline prices gone back down. So it remains to be seen. I don't have it a slide in here. Actually, there's new data that's still new housing starts. I think that was from a July figure that housing starts still continue to lag behind household formation at 1.7 million per year. But we'll go into to 2008 financial crisis. Really, the subprime mortgage collapsed our economy and just had domino effect on the entire global financial market. Really collapsed a lot of national economies around the world, primarily because of how the subprime mortgages were rolled into asset-backed securities, and they were sold in the secondary market. And the banks and the investors owned these loans. There were very lax rules in qualifying for mortgages, high risk, very subprime mortgages. I can't remember. Were you already in the practice 2008 or
No,
not? Okay,
no, I was
okay,
not at that time.
okay. But you and I know now with the new rules. I mean, you probably studied these in law school with Dodd-Frank Act, Consumer Financial Protection Bureau was stood up, the banks doing away with predatory lending. Now these are just these different entities like Office of Credit Ratings, and then banks having a shutdown plan in case of another financial slump, etc. So even the Financial Stability Oversight Council. So what are your perspective on this one? I'm not sure if you covered this in law school.
Yeah, so I think one of the biggest things that came out of all of this, I was sometime between 2014 and 16. I can't remember the exact year, but the closing disclosure and the loan estimate, the integrated TILA and RESPA, where now you used to get a what's called a HUD one. Now we call it the settlement statement and the closing disclosure.
Hmm.
And when you start working with a lender, you get a document that says, here's what we think you're going to need at closing. The lender has to have some reason at the end of the transaction prior to you going to the title company why that document or that figure has changed. So lenders usually predict a higher number.
Hmm.
They break down each thing, every single cost, so the consumer or the borrower can be more informed. That document didn't really exist before. There was really an uncertainty of what am I going to need. You might be told one thing and then get to closing and not have an idea. And then the day of closing is approaching, you might be scattering for money. So that corrected that issue. So I think that was one of the biggest improvements that were put into place. And when that was getting rolled out, I was in practice, so that was new for everybody. You still hear people
Okay.
calling it a HUD and all these old names that we used to use, but it's not that anymore. And there's a lot more information. There's a ton of disclosures that borrowers get before they even sign off on anything, before the lender can even do anything with a loan application. They have to give them it's over 40 pages of documents that borrowers should be reading before they go forward with their loan application. So I think that's a good thing for consumers. It may slow the process down some, but in the end, that is one of the corrections that were made to help prevent the housing bubble, to help prevent massive amounts of foreclosure. I remember when I first started out practicing, I would serve as coverage counsel for big firms in Illinois that would need attorneys to go and take care of getting continuances on their motions. And you would see other attorneys in court walking with suitcases like you're going on a trip overseas with these big suitcases of motions and foreclosure documents. It's not the same like it was. I don't think we're going to see that. I think one of the things is the way our government in Illinois is running the government with the taxes. I think we should be more concerned instead of a housing bubble, the way property taxes are being handled here. I think that's a bigger issue.
Yep, absolutely. I totally agree with you. So, moving on with another reason why highly likely, I mean, in all probability, we're not going into a relapse of 2008. Here's a Bank of America research and core logic information or data points. When I did my research on the reasons why this is not really a repeat of 2008. So, number one is that the portion of buyers with super prime FICO scores of 720 or above at now 75% versus 25% 2008. And then debt to income ratio, household debt versus disposable income, now around 30% versus highs in 2008 between 70 to 100%. It was just an insane number in terms of DTI. And then taking a look at, I'll just jump down to average home equity gain between Q1 2021 to Q1 2022 was $64,000. So really, there's quite a bit of equity now for homeowners. Just taking a look at the last 12 months of the year. Any feedback on that one?
No, I think that was a pretty good statistic. I think also, um, again, people are more informed, and lenders have tightened their credit requirements. People who want to buy an FHA, even there's more strict requirements for people to buy an FHA or even use a VA loan. You can't just There's not lenders just saying, okay, show us a pay stub and we'll give you a loan. Or there's really no documentation loans anymore. You can't do a stated income loan. Even to do a bank statement loan, you need to show a certain number of bank statements, a certain number of months of income. One of the things that got us into the problem in '07, '08 was people stating their income. I know of stores where there'd be taxi cab drivers saying I made $150,000, and that probably wasn't so. You can't do those type of loans anymore. They're not allowed.
Yep, absolutely. No, really, there's a whole lot of rigor in terms of lending policies and just screening out the home buyers to make sure they actually have the capacity to repay the loan. So this one is a nice graphic of, well, not just continental US, but Alaska and Hawaii. So what I like about, actually, in all honesty, what I like about the Midwest is that our equity gains are a little bit slow and steady. It's unlike, to me, it's unlike Florida and it's unlike California because housing just becomes very unaffordable for most people. And sometimes the more overheated to me the market is, the harder it lands if there's a market correction. So, do you feel the same way? At least that's the way I feel about the Midwest.
I think that's true overall. In certain parts in the Midwest, I think prices go extremely high, extremely quick, depending on where you're at. I guess the example I would use, if you're trying to buy a cabin and do short-term rentals in certain areas in northern Wisconsin, the prices are insane. How quickly they appreciate. So I would agree with that statement generally. It's also location-wise relative. So, but California and Florida, insane the prices and the way they appreciate as well.
Yep, absolutely. And this one was kind of surprising. This core logic went into metropolitan cities. And surprisingly, Chicago outpaced Miami or even Houston for that matter, and even outpaced New York and Boston. So remains to be seen. This is just one quarter of 2022. I think it remains to be seen what the entire year would look like. This is kind of surprising to me. But
Mm.
this particular LTV histogram, you'll see that a cluster, and this is a comparison between Q1 2022 and Q4 2021. You'll see that there hasn't been a whole shift in terms of LTV. A majority of the LTVs are clustered around between 50 to 54% to 80 to 84%. So what this tells me is that, again, the home equity on the property that people have is much, much more stable, and it's not an inverse of almost 95 or 99% loan to value ratio. So again, this is just an argument against the proposition that we're going into a repeat of 2008. And I think, again, this speaks to the stability of the market. Wouldn't you agree?
That, and I guess the other thing I would add, if you look at the '07, '08 and talk to lenders who were around at that time and are still doing business today, you would have people buying a home or an investment property, and they would close on the loan at the title company, and as soon as they close, they would do a simultaneous closing to pull an additional 25% out of the value of the home on a home equity loan to buy a jet ski or whatever it is they want to pull out, and they haven't even made their first payment yet. So you're essentially
Mhm.
borrowing 125% of the home's value. So you're doing a loan to buy the home, and then you're pulling out 25% of the value of the home before you've even made your first payment. That's not happening anymore. Lenders aren't doing that. So you have people negative before they even go into the house and turn the key in the doorknob.
Yeah, that's insane. And I, I'm much older than you. This probably tells me I'm a much older than you. Early 2000, I was not in the IT space yet from a profession perspective. And I do remember early 2000 that people were taking out home equity loans to purchase Yahoo stocks. Yahoo.com obviously was pretty hot way back then. And then we people were making the company I worked for up in the north side of Chicago Buffalo Grove. They were a managed services provider in the IT field, and the bonuses that managers were getting, people would come in with brand new Porsches. It was just an insane time, early 2000 in essence, in the technology space, where, like I mentioned, Yahoo stock was so pretty hot. AOL probably at that point in time was so hot. People were taking home equity loans to purchase those stocks. It was an insane, insane time. But here, Patrick Dodd with CoreLogic, he's saying that home prices were up 20% in March compared to 1 year earlier in the home price index. This has led to the
Wow.
largest 1 year gain in average home equity wealth for owners and expected to spur a record amount of home improvement spending this year. Now, this is a little bit probably dated, but still, it speaks to the fact that Q1 of 2022, we were really establishing tremendous records. And of course, now we're into August or leading into Q4 of 2022. I'm going to skip some of the data sets here, but I like looking at the graphs.
Hmm.
But the next generation of buyers, this bar chart is showing there's a dichotomy between younger millennials and the older millennials. And I don't want to spend the time how to make the distinction between the two, but really what this is saying is that buyers and sellers, the older and the younger generation, really fueled the market. What year is this? This was in March of 2021. And I think that this will continue to be the trend in 2022. So, what I'm saying is the demand still, or sincerely believe, will still continue to outstrip supply. We've talked about the housing starts and we've talked about this generation of buyers, which is the Gen Z, will be the next wave. Uh, I believe that demand will continue to outstrip supply.
I agree with that.
And then next one in here, this is again a graph. This is a screen capture of an MBS webinar, I believe. So I don't know if you can see it too well. We had a recession early 70s and early 60s. Early 70s, I'm not sure. Well, I'm not sure if you were born yet, but I talk about, and I distinctly remember we were actually impacted with the fuel crisis, early 70s, gas lines around the block, and we were impacted in the Philippines. And I tell the story that my mom had 200-gallon steel tanks put in the back of a small pickup truck.
Well,
And my mom had our driver fill it up, and come to find out, it's either one or both, or one of the tanks actually had a puncture in it, and it leaked the gasoline in our backyard.
wow.
So we lost all that fuel that we purchased as to stockpile in essence, and we lost all that. But that's my vivid memory of the gas lines of early 70s. Those were recessionary times. Early 80s had recession, but here, early 90s as well. In the Gulf War, we had a recession, but I do distinctly remember 2008. I was vivid, had a whole bunch of layoffs with a company that I worked for, and I was petrified as well that if I was going to get laid off. But again, 2008, the real estate market collapsed the global economy and then caused that recession. But right after around 2012, 2013, you'll see this graph of the housing price index or the house price index from Case Shiller continue to just, you'll see the trajectory of this is much sharper like this. So even with the exception of the 2008 collapse, home prices have really gone up. And I don't want, not I don't like, but I hear people say, I don't want to buy because I think we're going to have, or we will have a recession. We already are in a recession, and home prices are going to collapse or trend down. This is an argument historically how the housing market has performed, the US housing market, that is.
I don't think we heard you there, Bobby. The last part.
I think this graph that I just showed is an argument against someone procrastinating to purchase. I mean, would you agree?
I would agree. The one thing I would say is we're going on, my family and a couple of our friends are going on a vacation this coming week in a remote area in northern Wisconsin for a fishing trip. And I looked at the person that we're renting from for a short term rental, and they paid a lot less than what that home is worth a few years ago. And so the one thing I always say about real estate, unlike a stock, which I still believe in investing in the market, stock can be worth zero. A piece of real estate is always going to be worth at least a penny. So even when Detroit had the worst period of time, those houses were still selling for a couple of dollars. So I truly believe in the real estate economy and the real estate market. So now than ever is still a good time to buy real estate. It's always going to be worth something. You can invest for appreciation, generational wealth, to have a place to call your own, second home, vacation home, but there's still always value in a piece of real estate.
Yep, absolutely. And let's cover two more slides, and I think you'll be surprised with these slides. So this is the second to the last slide that I wanted to cover with you. Take a look at this one. So early 90s, like I mentioned, do remember this. It was hard to get a job. I was just getting out of grad school at Virginia Tech in Blacksburg, Virginia. I came back to Bourbonnais, Illinois, and it was really hard to find a job. I was interviewing all over. Anyway, that's a whole different story in itself. But take a look at this. So early 1990s, we had a recession. Take a look at the mortgage rate. It went, hopefully you can see this a little bit. Mortgage rate shot back up, but towards the end of the recession, it was actually trending down. And then it fluctuated a little bit. Early 90s, 18 to 13% interest rates. And between 1972 to early 80s or 1980, it ranged from 16 to 11.75%. And then I'm sorry, is that early 80s? That is, I'm sorry. And then early 90s, it was 11% to 8.75%. And then it fluctuated a little bit. Around 2008, with the start of the recession, there was a little bit of volatility, but the end of the recession, it went down to 4.875. So you can tell in here that during recessionary times, there's a lot of volatility with interest rate, but for the most part, it will increase up. And then at the end of the recession time, it will actually decrease down. So I think this is uh, a relief to think about that as inflation gets controlled, as manufacturing core CPI and um, the measures of inflation, GDP contracts a little bit, interest rates are going to be high, inflation gets tamed, under control, mortgage rates will be to or trend downward. And that will instill a lot of public confidence in terms of, hey, I can go back in the market and actually purchase a home to the price point that I originally wanted. Would you agree with that, or do you have a different perspective on that one?
Yeah, I think that's true. And some people who bought at the end of last year or middle of last year are probably not ever going to be refined. So I think that's true. Uh, a lot of what the Fed does with the money supply too is going to be impacting that. So I think that's a good point.
I'm sorry, what was I not sharing my screen earlier?
Yeah, you were not. I don't
Oh,
think people could see the
sorry.
slide.
Sorry. So this is the screen right here. I apologize. I didn't realize I wasn't sharing the slide. So this is the slide. This is quite a bit of long time of recessionary time, early 80s. I'm sorry. This is early 80s, and then early 90s is this thin line right here, and then this is 2008. But anyway, let's cover this last slide, and hopefully, okay, I'm sharing my screen here. You see in here in different when the Fed chairmen were different. Now, of course, we had Jerome Powell. During Volcker's times, you'll see the inflation rate in there, and during Alan Greenspan's time. But we can just focus on Jerome Powell's term here as a Fed chairman. So inflation, it went from 1.5 to 8.5. It went up to 9.1. And then the mortgage rate, as we know it, or it even hit 6% at some point in time. I think it's below 6 right now. And then these are the Fed fund rates. The expectation, the inflation response is that it should trend down, it should drop, like I mentioned. And then our expectation would be for the mortgage rate as a response should decline as inflation goes down. But in the same token, our exposure in the stock market is also trending down, but hopefully it will bounce back up. So here's a pattern. All of these different chairmen, Fed chairmen, tenure here, they all were very predictable, and all of these outcomes were very the same, and they were all very predictable. And I think it comforts me to think that as we get out of this recessionary times, mortgage rates will drop back to historical levels, and then uh, to what we were used to, between 3 to 4%, or
That would
even
be great.
2.5%, and think not even be able to see that actually banks are charging 6% or more. So I think that's comforting. But for the most part, we've talked about how the housing price index as a measure of home prices. It's still pretty solid. It still continues to trend up, irrespective of what kind of economic times we have or live in. So, any concluding words of wisdom from you?
Yeah, I think the biggest thing is not to worry about. I mean, you can't take it out of your mind. You're thinking to yourself, is there going to be a bubble? Am I going to be employed tomorrow? All of those things. I think the biggest thing is, budget for a home, because if you're paying rent to somebody, there's uncertainty about, are they going to sell the property? What is my rent going to be? Um, that's not a fixed cost. If you own a home, you know what your principal and interest is going to be. If you buy a fixed rate mortgage, that interest rate's not going to change. The monthly principal and interest is not going to change. The term's not going to change. The only thing that can change is your insurance and taxes. Obviously, you have repairs that you might have to do at some point, just like anything else. Um, but you're building value for yourself. So I think it's a good thing to buy a home. You can build generational wealth. Um, I think at some point rates will come back down, like we've talked about, and you can always refinance the home then. It's not the same market as it was in '07, '08, '09. It's definitely a different market. As you wait, it's time value of money. As interest rates go up, and there's calculators online, we can refer you to lenders who can help you with this. Every time the rate goes up, that's less buying power you have. Even if you make $1 million a year, as rates go up, that's still less home you can buy. So keep that in mind.
Yep, absolutely. Hey, Aaron, I know I have your contact information running down the ticker here, but tell people how people can get a hold of you.
Yep. If you'd like to reach out to us, we offer a free consultation. We help with entity formation, investment planning. We also have the Real Estate Academy, which is coming back in the fall. Reach out to us. We help investors or people thinking about getting into investing. We work with them to develop a game plan. So 847-284-0539. We're in Wheaton, across from the DuPage County Courthouse. Bobby will post all of our contact information in his after the stream is recorded and ready to go. So thank you for joining us on this stream.
Okay, thank you, Aaron. Hey, my name is
Thanks,
Bobby
Bobby.
Koyok. Phone number 773-372-7564. Alternate phone number 630-306-2684. It will be in the description of this video. Hope you have a great day. Have a good weekend. Have a good week. Thank you. Bye-bye for now.
Bye.